We are less than 10 minutes from the release of the June Producer Price Index. Joining us to set the stage for what to expect out of this number, Michael Darda is the chief economist at MKM Partners. Peter Schiff is the president of Euro-Pacific Capital. And Peter, I want to start with you on this because you've got some interesting ideas. We've got PPI coming out in just a little bit of time. Market really waiting on this number. Do you think this number matters? Well,
it might matter for the first 10 minutes of trading, but it certainly doesn't matter to anybody who's concerned about inflation. I mean, first of all, what the index purports to measure, the PPI and the CPI, are not inflation itself, which is an expansion in the money supply, but one of the effects of inflation, which is rising prices. But the problem is that the methodology used for calculating these indexes has been so changed over the years that rather than accurately revealing the inflation's effect on prices, what these indexes really do is hide how bad inflation really is.
You know, I tend to agree with you at least to some extent on this, but Michael, what do you think about it? Do these government numbers matter, and are they telling the real story here?
Well, I think they matter. I mean, they're certainly flawed and they're certainly backward-looking and they certainly do miss a lot. But if you take a look at really any of these measures of inflation, headline or core, they've all drifted up. The GDP price deflator is at a 14-year high right now. Core inflation's doubled off of its trough. So if it's understating inflation, the trends are still most definitely in the upward direction.
Sure, and imagine how much worse these numbers would be if they were accurate. Remember, back in the 1970s, when Nixon imposed wage and price controls, trailing prices were rising at a 4% rate. You've got PPI and CPI both rising year over year in excess of 5%. And back in the 1970s, of course, housing prices were part of the Consumer Price Index. There was no hedonic adjustments being made. There were no substitution effects being made. So the CPI was far more honest back then. So who knows how high prices would be rising right now if we were still measuring them the way they did during the Nixon administration.
Tom, I see you smiling over here. Do you agree with this?
I think most of it we agree with, sure. We think that the CPI has been understating the rate of inflation for the last couple of years. And it's important because you've got securities issued by the U.S. Treasury, Treasury inflation-protected securities that pay investors based on the increase in the CPI. So telling people that it fairly measures inflation, I think, is a little bit of an overstatement.
Liz Ann, what do you think? Is this a good measure of inflation? Should we be paying this much attention to it?
I think it affects the market, so you have to pay attention to it. But to judge it as a good measure of actual inflation, I would agree it's a terrible measure.
Okay.
And of course, the most irrelevant of all is the core number, which ironically is the number that Wall Street seems to pay the most attention to.
Well, they're guided to that number by some people at the Federal Reserve, I think. But the key question is, how does Bernanke and the other voting members of the FOMC, how do they view inflation? What's their favorite measure?
Yeah, well, remember, if you look at what the Fed's real job is, it's they're looking at expectations, and they want to try to contain inflation expectations, and the way they do that is basically to lie about inflation and pretend it's not a problem, and hope that by saying that loudly enough and often enough that the public will actually believe them. And
All right. We do have those numbers coming up. Stick around. We'll be right back with those government numbers and then tell you what to make of them. Squawk Box will be right back.
All right, Rick, thanks, and welcome back. Let's get back to our panel. Peter Schiff, president of Euro-Pacific, Mike Darda, chief economist, MKM Partners, and Liz Ann and Tom McManus still here. Peter, I mean, it is confusing. Either under 2% on the core or 5% on the headline. I guess you figure even 5 is understated.
Well, of course, I'm sure the media reports on the news are going to focus on the 0.2. I mean, in many cases, I watch the reports on the evening news when they talk about inflation. They don't even mention the headline number. They only mention the core number. But I think that 0.5% number is a big number. I mean, multiply it by 12, annualize it. That's a lot of big increase in producer prices.
Mike, does that bother you?
Yeah, I would basically agree. I mean, really, the core rates tend to follow the headline rates, maybe not so much for the PPI, but certainly for the CPI. There's about a 6 to a 22-month lag. So with headline inflation having risen so much, really across the board, I think we still have a rise in core inflation to go, probably to the 3% threshold by the end of the year.
And first of all, energy prices have risen 400% in the last 5 years. I mean, 400%. I mean, how can you exclude that? And they're likely to continue to rise. And food prices, I think, are really just beginning their rise. I look for next year, I think you're going to see some big increases in the price of food, and that's going to go on for years. And to keep excluding those two components makes no sense at all.
Tom or Liz?
Yeah, it bothers me, but maybe not necessarily because of the implications it has for the Fed. For whatever reason, good or wrong, wrong or right, they focus on the core level. But the problem is that in the case of PPI, with a rising headline number, that filters into corporate input costs, which puts pressures on margins. On the consumer side, the headline stuff, which includes food and energy, is adding to the cost of essential items. That is now 55% of disposable personal income. So that's hitting their own margins, so to speak. So I think that that's sort of a separate problem from what any of this means to Fed policy, which is another issue for the market.
Of course, and also what's not in there at all is interest rates, and interest rates are going to go up, and they're going to continue to rise, and that's going to put a lot of pressure on the consumer because he's going to be paying a lot more for his adjustable rate mortgage or interest on his student loans
That's part of
or on
the
his credit
essential
card.
items.
Right.
Yeah.
And Tom, we take a look at this number, though. Obviously, the core number is the one that's the most important to the Fed, but can they ignore a headline like this?
Well, I think there's some academic research that was done several years ago that said that the core was a better indicator of where the headline went than the other way around. I think that's really in dispute right now. Once again, the whole reason that you would take out food and energy is because the volatile month-to-month swings would make you unable to sense the real trend. We know what the trend is.
4.9% year over year.
We know what the trend is, and the key is when you look at anything year over year, to exclude anything like food and energy is just a mistake.
Of course, and remember, the government has an ulterior agenda or a motivation here. I mean, their true motivation is not to be honest about inflation, but to try to dampen expectations for future inflation.
Mike Darda,
Well,
the 2/10, does that make it, I mean, does that say anything about the CPI? Could have been 3. We had someone on this morning that forecasting 3/10. What about the CPI tomorrow?
I think probably we're looking at 3/10 tomorrow on the core CPI, and I think, year over year, by the end of the year, probably 3% or even a little bit more. What's interesting here is the Fed's assumption is that high profit margins essentially will absorb, or prevent a rise in finished goods prices. But I really think that's false. If we take a look at unit prices in the non-farm business sector, they're up at a 14-year high, even with no real pressure on unit costs yet. So if there's excess liquidity in the system, and there has been for a long time, and the Fed's trying to address it now, all up, and that's exactly what's happened.
What do you mean we're trying to part? The last time we got a 0.1% too much, that's what started the whole market sell-off. I mean, a 10th is that can be a huge problem.
But the Fed has vowed to try and block the pass-through between producer price inflation and consumer price inflation. And in order to do that, interest rates have to move higher. And the market, on the other hand, has been rewarding companies who've been able to pass through cost inflation into price inflation for some time. 50% of the gains made over the last 2 years have been in energy, materials, and industrials. The other companies, the ones who have been inflation victims, have been underperforming the market. If the Fed is successful at blocking this inflation, if the Fed is successful in slowing down and this economy slows down a little bit, you could see a major rotation in the market away from what's worked in the last couple of years towards what hasn't worked.
Although it tends to take some time before the Fed hikes rates, before that actually affects inflation. What are we talking about, a year down the road?
But the stock market tends to sense these things faster than the published economic data.
The interest rates are still negative. The real rates are still below the rate of inflation. So despite the fact that the Fed has inched up nominal rates, real rates are negative. Inflation is still getting worse, not getting better. And remember, the government is creating inflation. They're not trying to prevent it. They're trying to prevent the effects of inflation from being appreciated by the marketplace, from being appreciated by America's creditors.
Hey, Peter, if your analysis of how the government understates it, it's been going on for decades, understating.
Well, it got a lot worse when Boskin was in, during the latter part of the 1990s. Okay. But sure, governments.
But where should gold be if the underlying? I mean, in your model, you should gold should be at $2,000. If it's been understated.
I don't know where. I think it should be a lot higher, and it's going a lot higher. And obviously, it's going to take some time to get there because markets could be inefficient in the short run. I mean, you know that the Nasdaq was at 5,000 in 2000. Should it have been there? So I think gold at 650 makes as much sense as the Nasdaq at 5,000. So gold's going higher.
What's a fair value for gold if it's been understated for the past 9 years and one or 2 or 3 times what it should have been? Where should gold be? It should be at $2,000 or $3,000.
That makes a lot more sense than 650. If you
I disagree.
I just think you'd see it somewhere in something that other than.
Look, right now, Joe, you're in a situation where we're coming off a period of maximum complacency and trust and confidence in central bankers.
Michael, why don't you buy it?
Well, I mean, look, if we're going to see additional upward pressure on inflation, especially the core rates, and that's what the Fed follows, and they move short-term interest rates enough, then eventually the steam will come out of commodities. I don't know how high that, that level of rates
I don't think it will
be required, but we'll see.
Because what's going to happen ultimately is higher rates are going to push the U.S. economy into a recession. The dollar will collapse in that environment.
Well, that's a no-win tautology then. Then there's no way for anything else to happen except for, what you're expecting. So.
Well, we're in for a lot of trouble. There's no way around it. I mean, we created this problem for ourselves. We can't get around it through inflation or printing money or trying to keep interest rates low. We've got to pay the piper for the sins of the 1990s. There's no way around it.
All right. We'll leave it there, and I think we'll talk again. You guys are good together, Peter and Michael. Mike Darda, Chief Economist at MKM Partners. Peter Schiff, President of Euro Pacific Capital.